Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 8.83% year to date. And today's date is October 14th, 2023. So that's where we stand. Our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 12.69% year to date. So we are not accomplishing our goal. Our goal right now is before the end of the year is to beat that return. So we are getting closer, and I'll show you that in the presentation later on, and you'll see it in our equity curves. We are definitely making headway to beat that return, but we're not there yet. So that's where we stand. We do a very simple portfolio, 3-position portfolio here at SPY Trader Now. We start the year off with $100,000 and we build from there. Currently our portfolio is up to $108,825. And see, what else can I tell you about this portfolio? I say that we are a trading account because we do trade the S&P 500, but we do this with investment grade capital, not just trading capital. So in your investment grade account is this money that in the model portfolio can be deployed because it's done in a conservative fashion. Last week, the S&P 500 gained 0.46% for the week. We'll go through the charts in much greater detail later on in the presentation. Here are the trades that we made last week. On the 11th, we put out a sell to close our long call options. We profited on those. And because I saw market weakness, I also wanted some downside protection. So I put on 2 in-the-money covered calls because we still hold 200 shares of SPY. In addition to that, on Friday, I saw more market weakness, so I wanted to dip my toe in the water and I put on 1 put trade. And here's the exact trade I put on. Here are my recent trades for 2023. If you want to see all my trades going back 3 years, head over to spytradernow.com. Also, there'll be a link in the description for this, as well as everything I am presenting today. Now, if you also want to download for free the spreadsheet that I use to capture all of my trades and monitor my equity curves for my trading account, for my portfolio account, I should say, you can also go to spytradernow.com and you can download this for free. Here is the equity curve for our model portfolio year to date. Here is the equity curve for the buy and hold S&P 500 buy and hold investor year to date 2023. And here are the 2 equity curves combined because we want to compare our model portfolio against the benchmark of the S&P 500 buy and hold investor. Now, last week we had a very good week because of the way we were trading our account, and the S&P 500 did have a positive week, but just not as good as our week. Now, if I'm correct and the market comes down over the next 3 weeks, our portfolio is positioned to profit during that time frame, and you'll see that in the presentation. So we will hopefully surpass the buy and hold investor within the next month. That's our goal. Here is the Fed Chair, Jerome Powell, and here are interest rate movements over 2022, 2023. The last announcement, it was a pause, there was a skip, nothing was done. The next Fed announcement will be on November 1st. That's about 2 weeks away. And are we going to have a 25 basis point rate hike or a skip? Right now, I think it's about 50-50. It's really tough to say what direction this is going to go in. Now we are looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500 and for the NASDAQ 100 symbol QQQ. So you can do a comparison analysis against these 2 indexes. Currently, President Biden is in his third year of his election, and this is 2023, and historically that equals 16.3% rate of return for the S&P 500. Currently, the S&P 500's year to date is up 12.69%, allowing room for this market to advance between now and the end of this year. Now we are looking at things from the bond market outlook. The bond market is saying to stay out of the stock market because we have an inverted yield curve, although we are getting closer to a normal yield curve, and we also have rising interest rates. We just want to recognize that there is an elevated risk going long in this market during this condition. Now we are looking at things from a valuation standpoint according to CMV. The link is here and down below in the description. According to CMV, we are overvalued on a PE, price per earnings ratio, above the average 43.4%, which puts us at 1.1 standard deviations. So there is caution, and we do have risk going long at this valuation. Now we are looking at things from the CNN Fear and Greed Index. Here's our friend Warren Buffett. Currently we are in fear. Last week we hit extreme fear. Now we are looking at things from a seasonality outlook. This is the summer doldrums, August, September, October. We're currently in the month of October. For the month of October, the S&P 500 has gained 0.94% for the year. There's a 65% probability that we're going to close the month higher than when we opened the month. But this is still the summer doldrums, and you can have wicked moves in the month of October. Now we are looking at things from a long-term outlook. It's a monthly chart, S&P 500 going back 20 years of data. Look at the bull market from 2009 all the way up to 2022. We stayed above this line, and we are still in a bull market as long as we stay above this line and this line here. So we are currently above both these lines, and we just wanted to monitor this and make sure we're good. The MACD is getting closer to touch its signal line, but it has not done so yet. You can see here in the thumbnail where the S&P 500 has corrected off of this high, but it also is not crossed below all of these moving averages, which is still a bullish sign on the long term. Now we are looking at things from an intermediate term outlook. S&P 500 weekly candlestick chart going back 5 years. We are in this trading range between this low range and this range here. So we found support, started to go up, but I saw weakness in the market, and I'll show you that in the next couple slides. And that is why I took a more conservative approach to the portfolio. According to this chart, the market looks bullish, like it should find support here and continue up. But I'll show you as I go through this presentation why I chose to take more conservative positions in my model portfolio. Now this is a short-term outlook. We're only going back 6 months, daily candlestick chart. You can see the different trading ranges that this market has experienced and where we stand right now. Now, we did break out of this downward trending channel here, and we came up, but now you can kind of see a rounding top. You'll see this rounding top in a lot of these short-term outlook charts. You can also see the MACD is topped, getting ready to cross below its signal line. Actually, it has crossed just below its signal line. MACD, you can see, has clearly lost momentum as well. Now, you'll see here that on the in-the-money covered call that I did, the strike I did was 420. Well, you'll notice here that this market found support right at 420 before it came up and advanced during this time frame here. Now, my expectation is for there to be market weakness and come down and actually take out the 420, go and come down here to 410 or even possibly a low of 400. That's what I'm expecting in the next month. Now, we'll see. We'll see how this all plays out. I didn't take such a low strike price on my trades. I just did a 420. I can always buy to close and sell again with these lower strike prices if indeed there's continued market weakness, because I want to profit as the market falls. That is the benefit of doing this strategy compared to being a buy and hold investor, is that you can take advantage of market weakness and make money. Now we are looking at a ratio chart of the equally weighted S&P 500 against the normally weighted S&P 500. So there's three charts here. The ratio chart is in red and black. The normally weighted SPY S&P 500 is in blue, and the equally weighted RSP is in lime green. This is going back 20 years, folks, weekly chart. We've fallen off of a cliff on the ratio chart 3 times, basically, in 20 years. Now, the last 2 times that we did it, the S&P 500, which is in blue, had good waterfall declines here and here. This is 2023. This is where we are right now. No waterfall decline. Ratio chart decline. Ratio chart decline here, waterfall decline, S&P, but no waterfall decline in the S&P. If we want to go long, we have to be careful of a waterfall decline happening in the next 6 months, because that's approximately how much sideways trading action after the ratio chart falls off of a cliff, how much sideways action you get before we're off to the races and we have a nice bull run. So we want to be careful that we don't lose our shirt during this waterfall decline if and when we get it. So we need to watch this to see if we're going to get that waterfall decline, like it's happened over the past 2 times in 20 years. So you would think that we're going to get another waterfall decline. We just don't know exactly when, and it has not happened yet. The MACD has gone negative, putting further pressure to get that waterfall decline. And if you look here at the slow stochastics, you can see how the black signal line came up, kissed the signal line, and now has crossed back down negative below it. There's definitely weakness in this market. You can see it on this chart. This chart is one of the reasons why I positioned my portfolio to be more protected against market declines. So this chart is helping me to make that decision. Now we are looking at the VIX, which is the volatility index, the fear index. And you can see that there's kind of like 3 ranges here. This ultra low trading range, this trading range, and then above 20, this trading range here. Now, last week, especially on Friday, we started to push into that above 20 range. And look at that, big white bar telling me that this market is wanting to push up, which means that the bears are going to be more in control and this market is going to fall down. This black line here is the S&P 500. You can see it here and you can see it right here, okay? So and you got to understand, as the VIX goes up, the S&P 500 goes down. The MACD is showing that it wants to go up. It is clearly bottomed, ready to cross above its signal line. Slow stochastics, from a low valuation standpoint of 20, has already crossed above its signal line, leaving plenty of room on the chart for it to advance into 80, leaving the MACD ready to go positive. That is going to push this above where it's at right now. And we have the 50-day moving average also on the VIX. And we are trading above the 50-day moving average here. We bounced off of it it looks like it was on Thursday. So it came down, had a tail below it, but closed above it, and it's been above it ever since. That leads me also to believe that there's further market weakness ahead of us over the next month. This chart is also helping me to tell me to position the portfolio conservatively. Now we are looking at things from the Think or Swim platform. And this is a 1-year chart where we have standard deviations. Now, there's some information about standard deviations here, if in case you don't know about them. And the +2 and -2 in gold, +1, -1 in pink. This particular pink line here is the 100-day moving average. This green line is the 50-day, and the black solid line is the 200-day. Market came down, found support at the 200, but now it's starting to come up from the bottom side of the 50 and the 100, and it looks like a rounded top. It looks like it doesn't have the energy to get above the 50 and the 100, which it's right there. So that leads me to also believe that we have further downward pressure in this market. Now we are looking at the same chart, but instead of going back 1 year, we're only going back 6 months. Here, you can see on the standard deviations, we're at -1.3, giving plenty of room for it to come down before it hits 2. And you can see that rounded top a little bit better. Now, I've got market alerts that are going to tell me exactly what's going on, just in case I'm not watching the market, because I'm not a day trader. I am a momentum trader. Now, in case I'm not looking at the market and this market starts to go up and it takes out this high right here, I'm going to be notified. If it takes out this low, I'm also going to be notified. So otherwise, we're just stuck in this trading range between 420 and 453. All right, now on last week's presentation, I gave you a sell zone that I was going to see if the market was going to come up into, and I was going to sell my positions. We never hit that sell zone. I ended up taking my positions off the table during these last few trading days. And I also put on one put, which is a very small position, on Friday's action, because I can see this rounded top. I can see we're coming down. I can see this market coming down to easily 420 and possibly to 410. I have just given you a ton of information in this presentation, and now comes our critical thinking. What are you going to do with that information? October 14th, 2023, market summation. According to me, Ken, your host with Spy Trader Now, on Wednesday, 10/11, I sold my long calls as I saw that resistance. You see it in the charts, and that's when I sold also an in the money covered call for downside protection, which I showed you all my trades. On Friday, 10/13, I put on one long put as I see market weakness. I have nothing to do now, as we have our positions in place for the model portfolio for next week. I'm going to wait and watch. I do have an expectation for the market to take out the 927.23 low of 422.29 and go down to somewhere between 400 to 410 over the next 3 to 4 weeks. And this is how I plan to trade this market. I'm going to stay in my put, and I'm going to add to it if we close below 428. I'm going to stay in my in-the-money covered call, and if this market comes down to 420, I'm going to buy to close the position. I'm going to keep my shares, my 200 shares of SPY, because the market will eventually come back up, and when that does, I want to be holding those positions. So this is how I'm going to profit while the market is showing weakness. If I am wrong and the market goes sideways, I may sell my put to close the position, because it's not going to do me any good to be holding an option. I'm going to lose time value if we have a sideways market. If I'm wrong and the market goes up, I'm definitely going to sell my put because I made the wrong call. And I'm going to hold my in-the-money covered calls and wait till I get closer to expiration, because I'm going to receive time value. Because now when you sell a call, time is your friend. When you buy a call or a put, time is your enemy. But in this case, I sold an in-the-money covered call, which means time is my friend. So I have time on my side. I can wait and see how this market does, just in case this market begins to turn around and go up unexpectedly. I'm not expecting that, but hey, the market's going to do whatever it wants to do whenever it wants to do it. And then I'll evaluate as I get closer to the expiration date. Overall, I am expecting weakness till the end of October or November. I'm pushing that out a little bit, just in case. Normally, November is a good month, but it's possible that this whole capitulation or market downturn that I'm expecting could take a while to develop. And then I'm still seeing strength till the end of December at this time. We'll see how this market weakness plays out. If this market turns into something else, then that will change this prediction of strength till the end of December. So that's it. That is my presentation for this week. I hope you've gotten some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell. Help me promote this video by smashing that like button down right now. I thank you, and I wish you good trading.